In 1942, an 11-year-old boy in the US, Nebraska, took every penny he had, $14.75, and bought 3 shares of a company called City Service. Today, that boy is Warren Buffett, the most successful investor of all time, worth over $100 billion. But here's what most people don't realize. His strategy, it's not complicated, it's not technical, it's not even particularly clever. It's just long-term, logical, and very simple. Now, I've been investing through multiple crashes and recoveries over the last 24 years, and a big part of my success has been learning from the biggest investors like Warren Buffett. So in this video, I'll tell you exactly what led to him becoming the richest man in the world. Chapter 1, Buffett's early mistake. Now, before I get to Buffett's early mistake, I'll tell you mine. Basically, I started investing into the stock market at 18. But after 6 months, I used that money to go to Ibiza with the lads. This was a huge mistake and was mainly down to a lack of financial education. Hypothetically, if I'd have kept on investing £500 per month between the age of 18 to 40, I would have made £476,000, assuming I got 10% returns each year on average. What's your most expensive mistake as an investor? Anyway, back to Buffett. When Buffett started, he got it completely wrong. So if you do make mistakes as an investor, don't beat yourself up, because even the best investors of all time have made plenty of mistakes along the way. He obsessed over price charts, technical analysis, indicators, everything that makes you look smart but rarely works. He read hundreds of pages trying to predict what the market would do next. Buffett admits, I thought stocks were things that went up and down. I tried to forecast them. I was doing it exactly the wrong way. And this is where most investors today still trip up. They watch Sky News, check the investing app like Hargreaves and Lansdown every few hours, panic when the FTSE drops or the S&P 500 drops or wherever they invest, and chase whatever's trending on Reddit, YouTube or X. That's not investing, that's speculating. If you want to know the 4 assets I'm never selling, just to give you an idea of what to actually buy, see below for a recent video. Chapter 2, the book that changed his life. Everything changed when Buffett discovered The Intelligent Investor by Benjamin Graham. Sometimes all you need is one book that changes everything. If you type book below, I'll tell you a UK investing book that I read 3 times in 1 week back in 2019, and it massively changed the way I invested in the stock market. Anyway, in that moment, Warren Buffett stopped trying to predict the market and started thinking like a business owner. He didn't see stocks anymore, he saw businesses. He said, from that point on, I never bought another stock. I bought businesses that happened to be publicly traded. Imagine if you did the same. Instead of asking, what's the stock price? You ask, is this a good business? Would I want to own it for the next 20 years? If the market shut down tomorrow, would I still be happy owning it? That's how the wealthy think. Now, if you want to get wealthy, you need to invest in businesses or own a business. Chapter 3, what Buffett really buys. He's the biggest shift in mindset. Buffett never cared about buying stocks. He cared about buying productive assets. He treats every purchase like buying a home or a farm, something real, useful and long term. Here's a little UK comparison. When Brits buy a house, they don't check Zoopla every hour, hoping the price increases. They don't sell it the moment prices dip. They buy it for utility, stability, and long-term value. That's exactly how Buffett treats his investments. I've used a property analogy because I've been investing in property since 2002 and feel property is a must in a well-diversified investment portfolio. As you might have guessed, I'm not a financial advisor, and this video doesn't contain any financial advice. Chapter 4, why passion beats intelligence. Another myth, that you need to be a genius to get rich. Buffett says you probably need an IQ of 120, but anything higher might actually hurt you. What matters more? A calm temperament, patience, and a deep love for what you do. From my experience, if you can zoom out and think long term, this brings calmness. Another tip is to read the books and learn from investors like Warren Buffett and Ben Graham. Don't worry if you didn't study finance or you didn't go to Oxford or Cambridge. If you can think clearly, stay rational under pressure, and stick with a plan, you've got what it takes in my humble opinion. Chapter 5. Why Buffett loves market crashes. This next bit will shock most people. Buffett loves when stocks crash. He says, I hope stocks go down. It means I can buy more with the same money. I heard this time and time again back in 2019 when I was first learning about investing, when I first started taking financial literacy seriously. It's counterintuitive, but it makes perfect sense. Would you be annoyed if your favourite foods were on sale or your favourite clothes? Of course not. So why panic when investments are on sale to go down? Here's a little mindset shift. Instead of fearing downturns, see them as your chance to build wealth on discount. Chapter 6. The UK Investor's Edge. Here in the UK, we've got massive advantages most people don't use. Stocks and shares ISAs, tax-free investing, pensions with free government top-ups, low-cost index funds like the Vanguard FTSE UK All Share. By the way, if you want access to my index funds cheat sheet, see below for more details. Here's what most people do. Chase crypto without a clue. They go for quick, easy money. Now I do invest into crypto, but it's not easy and I wouldn't recommend it to anyone just starting out as an investor. Most investors panic sell when the FTSE 100 dips or the S&P 500 dips, or worse, they leave money in cash, earning nothing. Buffett's approach is timeless. Stick to what you understand. Stay invested through crashes. Focus on value, not hype. It works in America, it works here, it works everywhere. Chapter 7. Let time do the work. The real secret to Buffett's wealth, he started early and never stopped. He was 94% richer at 65 than he was at 50. Not because he got better, but because he gave compound interest enough time to work its magic. Even if you're 30, 40, 50, it's not too late. I've met far too many contractors over the last 25 years who have got to 60 and start to panic as they have little or no pension. Please take what I'm saying on board. The key is to start now. Start small and don't stop. Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Which side do you want to be on? Investor or saver? Or worse, no savings at all. Chapter 8. Final words from Warren Buffett. In one interview, Buffett made a stunning observation. Even the bottom 5% in the US or the UK live better today than the richest man in the world did a century ago. This is a well-known fact. Think about it. You've got better healthcare than Rockefeller, better entertainment than royalty did 100 years ago, more access to knowledge than ancient kings. The list goes on and on. We're living in a golden age, yet most people waste it. Don't be one of them. Build your wealth slowly, patiently, and rationally, just like Warren Buffett, because getting rich isn't about being lucky, it's about being consistent. Summary. So, here's what to remember. Don't chase hype. Own businesses. Be happy when stocks fall. Use your ISA. Max out your pension if you can. Let time and compound do the heavy lifting. If this helped you think differently about investing, hit the like, subscribe, and let me know in the comments out of interest. What company or fund would you hold for the next 20 years? Personally, I'd have to go for Tesla.